Hi, welcome to the Investment Blueprint. I'm your host, Raghu Kumar from Rain Platforms. The Investment Blueprint is a podcast where I interview traders, investors, quants, and finance professionals in the space of retail trading and investing with the goal of helping pass on their knowledge to you. Today, I interview Karthick Jonagadla, the founder of Quantace Research. Quantace Research aims to provide quant investing and trading advice by leveraging quantitative research and data science. The company is currently live with multiple quant investing portfolios. In a short period of time since the launch in the last 3-4 months, it has portfolios in every market category that outperforms the benchmark index it tracks, and also the top performing mutual funds in that category. Today, we talk about Karthik's interesting story with the financial markets, the major learnings he has absorbed over the years, and his goals for the future. So, Karthik, welcome to the podcast.
Hi Raghu, glad to be on Rain platforms.
Awesome. So, Karthik, obviously, this is our second run doing this podcast, so hopefully it's not boring. But, how did you get introduced to, trading and investing?
So I was introduced to Quant Investing and Trading way back in December 2013. So when I joined Motilal Oswal as a quantitative analyst in the retail desk. So I was good in math, stat, and knew how to write a code. So my hiring manager was actually looking for a person from a different industry altogether. So one of the most critical factors that helped me back the role was that I didn't have any prior domain experience in finance. So my hiring manager, he believed that a person who's not conditioned to think in a particular way is best suitable in this role, where the person would go ahead and challenge the uh, established notions and come up with ideas. So I knew I was uh, kind of taking a risk, but I went on with my instinct and took up this opportunity. The risk I took ultimately paid well. So I was part of the country's first retail contest. I believe there wasn't any other retail broker out there during that time who had a desk in retail team. In the first year, we created a portfolio optimization tool where we pushed, customized advice to approx 3 lakh plus clients every week. So for trading, we automated a lot of quant ideas like paid trades where we go long on one security and go short on the other security, and option writing, which is kind of a time series forecasting. And when I joined, it was a three-member team. But when I quit Motilal Oswal, it was a team of, say, 15 people.
Wow. Okay. So basically, you were new to the quant world, right? It's not like you had like a lot of experience being in the capital markets and the quant space. So, do you think you faced any early challenges when you kind of, migrated to this field for the first time?
Challenges were there. Initially, I didn't know anything about capital markets. It took me about, say, 6 to 8 months to find my feet. And but since I was really good in stat and math, so it's basically a stat and a math problem. So I used to do a lot of reading on internet and find out like what is the best practice and what are the approaches being used. So that's how I slowly started building, knowledge in this space.
Got it. What are the basic fundamentals of your math background and your stats background, which you were able to apply to the capital markets?
So most of it is to do with regression. So we use regression a lot, and apart from this, we use a lot of time series analysis, where which is kind of an econometrics. So we forecast prices. So it was a new field altogether. So I mean, if you do enough research and put in the hard work, it will be an easy switch. So as long as you're confident about your skills.
Sure. Yeah. So, in our first conversation, when you kind of briefed me about yourself, you mentioned something very interesting, which is that you grew up in a family where, you guys didn't really believe in the stock markets, I guess, or I guess maybe you didn't have exposure to the stock markets. So, how did you have the conviction to kind of go against the grain and kind of jump into a field where your family had no kind of prior experience in that field?
So actually, my father's father believe that stock markets are an equivalent version of casinos. So and we as a family made some wrong investment choices too. I mean, we invested in products like which is not suitable for us. So, for example, say ULIPs, so which didn't work for us. So all this, I mean, made my family kind of averse to stock markets. But I mean, I was working with Ion as a system analyst. I had a great career there. And I was one of the top performing employees. But I wanted to work on something which was more challenging and then started exploring different opportunities. So when I got the offer from Motilal Oswal, I had a long conversation with my parents and explained why I wanted to take it up. So they supported my decision, and that's how like I ended up in Mumbai. And it's been a different journey altogether after I came to Mumbai.
Got it. Got it. So you came to Mumbai in what year?
December 2030, and we are in December 2021, exactly 8 years back.
Right, right. 8 years, yeah. Got it. So something else you mentioned to me, the first time we spoke was between the years of 2014 to 2017, you grew very discouraged because basically you had invested in, I guess, some mutual funds, or I'm not sure in exactly what, but basically the investments were going against you, but you had a lock in on those investments, and so you kind of wrote it out, and eventually the investments ended up doing very well. What were the learnings of that whole experience, and can you walk me through that entire experience?
So, as a research analyst under prevailing regulations, so we cannot have any direct exposure to direct equities. So we can invest in mutual funds. So and mutual funds were one of the most optimal ways for I mean, for analysts like me to take exposure to equity markets. Nifty had a spectacular bull run in the year 2014. So this coupled with my need to make some ATC investments to claim tax benefits lured me into buying tax saving mutual funds. So I've invested about 1.5 lakh in February 2015, and another 1.5 lakh in April 2015, which was the new financial year. So when Nifty was trading around 8,800 levels. So the following year had not been kind, and the index fell by approximately 1,800 points and made a low of 7,000. So that was when I cursed and ruined myself for making this investment decision. I actually wanted to pull my investments out, but unfortunately, those were in lock in and I couldn't pull it. So, and I had to wait it out. And 2017 had been a spectacular bull run year. So, and Nifty traded at 11,100 pre-budget 2018. So I learned my biggest lesson here in investing, that patience combined with SIPs is the virtue. And for investment to grow, time spent in the market matters more than timing the markets.
Time spent on the investment matters more than the time spent in the markets.
Yeah.
Can you elaborate on that?
No, I was saying that time spent in the markets matters more than timing the markets. So a lot of people try to time
Oh,
the
then timing
markets.
the markets, right? Exactly, right, exactly, 100%, 100%. You have to be invested, and those lock-ins can actually, play in your favor, right? Because because it forces you to stay invested even despite the investments going against you. Um, Interesting, interesting. And so something else you also mentioned to me right around that time, right? So basically in 2018, when the 2018 budget was passed, and that's when the long-term capital gains tax was introduced in India. You basically had like this interesting kind of learning and lesson involving volatility and high beta funds, and how, according to you, volatility kills the portfolio. Can you elaborate on that?
So in 2018 budget, Sri Arun Jaitley introduced long-term capital gains. So market didn't take this introduction kindly, and the
Right.
index tanked by approximately 15-16% in next 2 months. I mean, when I checked my portfolio, it was down 20-22%. And I understood that it was because of my exposure towards I beta funds, which contributed towards this gross underperformance. So my belief is that I beta funds, if not appropriately designed, will lead to volatility in your portfolio, which kind of kills your portfolio. So we must know how to handle this volatility. Fortunately, quantitative methods like asset allocation and modern portfolio theory addresses this problem. So even, I mean, people like Ray Dalio advocates diversification as the holy grail of investing, which is one of the ways to reduce the portfolio volatility. So he actually talks about correlations, and this is what I believe matters.
Can you give me like a practical example of how you would deal with the situation, right? Like you're essentially looking to, introduce diversification to your portfolio at some level, right? And that can lower the general volatility of your portfolio returns. Can you walk me through just like a general example of that whole thing?
Okay, so I'll walk you through an example which I know. So in banking, if you look at most of the fundamental analysts, they're bullish on both SBI and ICICI, and they're bullish on HDFC Bank also. But if you look at the beta of HDFC Bank, it's one of the lowest for the banking in the banking space. But if you look at both SBI and ICICI, so both are, I beta names. And so if you pick both of these names in your portfolio, so you'll kind of see volatility because both are highly correlated. So which leads to, I mean, more risk in your portfolio. So what is important is creating that returns from non-correlated asset classes. So which I believe in banking, you can either choose say HDFC Bank and Axis, or HDFC Bank and ICICI, but not say ICICI, Axis and SBI together.
How do you actually go about making that decision as to what to pair it with?
Um,
Do you
so
use some
uh,
sort of a formula, or yeah?
We have this modern portfolio theory where we can, which is kind of a constraint optimization problem. So where we can uh, get a solution as per our requirements. So if you instruct your optimization problem to minimize the portfolio risk, and say uh, hold only 5 to 6 stocks. So you'll naturally see a lot of highly correlated stocks being removed from your portfolio.
Got it. Got it. So, you've been in this whole field for now, like what, 8 years, right? We just talked about that. And you started off your whole career in the capital markets with Motilal. And then eventually you also got institutional broking experience at Antique Stockbroking. How do you think your experience at Motilal and at Antique kind of shaped who you are today, being the founder of Quantace?
So I believe that challenging the status quo is a very critical skill any researcher should possess. So as a quant, I learned to make efficient decision making using data analysis. So rather than just going by bookish and theoretical knowledge, so I spent my time at Motilal Oswal and Antique. So to learn about more practical approaches, like which will kind of give you actionable insights. So this equipped me today to differentiate between noise and signal in a market. So at Antique Stockbroking, I started tracking the market observable factors such as seasonality, volumes, delivery volumes, future cash basis, and option chain data. So, I mean, I can go in depth about each of this topic, but that would take a lot of time. But when I kind of researched on all these, it kind of gave me an informed view of what's happening in the market. Just for example, if you take future cash basis, so whenever you see the future cash basis shrinking, so you can kind of say, only two possibilities are there. One is that there is heavy cash buying in market, which means that people are buying in cash and selling in future, or there's heavy future selling in the market where people are shorting the futures and thinking that like it will go down. But if you kind of do an analysis and see whenever this basis rings, so there is a inverse correlation. So you can see positive returns in say next 2 months in an index. So
Got it.
what
Got it.
what matters is that like if we can establish there is more of a cash buying than future selling, so we can safely, go ahead and kind of take a small position in the market, saying that like yeah, probabilistically like I'm right now that it might the index might go up.
Got it. So basically, you've been able to kind of leverage a lot of that knowledge that you were able to kind of accumulate at Motilal and at Antique, and you started Quantace, right? We'll talk about Quantace in a little bit, but now I want to talk about the third major lesson you've kind of learned over the years. So your first lesson was about patience. Second was about volatility, can kill the portfolio. And the third has to involves liquidity, right? So essentially, your basic premise is that liquidity matters a lot, which has allowed you to disprove the efficient market hypothesis theory. Can you elaborate on that?
Efficient market hypothesis is one such theory which a majority of market participants believe in even today. So, it says that the current price reflects all the available information, and alpha generation is impossible. So, for example, liquidity, as far as liquidity is concerned, so the current stock price is a function of a simple demand versus supply for a stock. So when there is high demand, then supply for a particular stock, then the price will naturally go up, and vice versa. So we can kind of forecast this supply and demand using quantitative methods. And if you look at it, if you actually look in markets like ETFs is a very popular way to invest. So the stock weights in ETFs keep changing. So which presents an opportunity whenever an index rebalancing happens. So the
Mm-hmm.
this index rebalancing often creates opportunities that that kind of creates artificial supply and demand in markets for that particular stock. So we can go ahead and use this information and make short-term trading. Ideas in these stocks. So this kind of index rebalancing occurs frequently. So if you look at it, like some of the rebalancing happens say every quarter for indices like Nifty indices, CPSC, Barrett 22, MSCI, and FTSE. So all indices have their own methodology. So if we do some research and find out which stock is going to come in and which stock is going to come out, like we can use that to make some nice trading decisions.
Sure. And I'm assuming, doing all this in a quantitative manner only helps, right? Because it probably improves the decision making process.
Yeah, so a quantitative methods like it. I mean, you can kind of automate it, and you can get that done in say less than a second, maybe. So,
Yeah, exactly. Versus spending hours and hours. And let's also talk about your master's in financial engineering that you received at World Quant University, right? You basically, it's a 2 year program, and you took up a project involving the problem of building a quantitative portfolio which can outperform the benchmark with less risk. It's a really nice project. So tell me about the project and the general learnings that you were able to absorb from the project.
yeah, it is this project which actually helped me to lay the foundation for Quantized Research. So this project is an amalgamation of all the learnings that I had gained practically as a quant and new concepts like which I learned at World Quant. So I took up this ambitious project like where I'm kind of addressing a well-known problem in financial markets where actively managed equity funds underperform the market. So 90%
Exactly.
of the
Yeah.
funds, in fact, underperform the market. So it's a
Right.
three-step process like which I follow. So step one is to use my proprietary quantitative research to create an initial set of stocks, which is kind of a secret sauce for my stock selection. So I use statistical techniques like regression and clustering to arrive at this desired group of stocks. So next is a classic optimization where which involves modern portfolio theory. So where we maximize the returns and minimize the risk of the portfolio. And step three is simulation. So where we try to simulate various scenarios. So we use Monte Carlo and historical simulation techniques to ensure that our portfolio risk is under acceptable levels and we do not add any unwanted risk to the portfolio.
Got it. Got it. So basically, it's amazing how everything leads to something else, right? So you did the master's program, and then eventually you got into the capital markets formally, and now you are running Quantace Research, right? So how did you decide to start Quantace Research? What was the basic, pain point you were trying to solve? And how do you guys kind of operate? Like, tell me all about Quantace Research.
So a Quantace provides quant investing and trading advice. So, and we aspire to be the most admired wealth tech company. So currently, we are solving a well-known problem in investing space, that is to outperform the markets. So, where I mean, our performance till date has been good, and we have made an alpha of more than 2.5% for our portfolios in 10 on 16 portfolios which we are currently live with. And we have a portfolio for every risk profile of the investor. So, be it aggressive investor, conservative investor, or a balanced investor. So, and we have portfolios tailored in every market category, like say large caps, mid caps, small caps, multi caps. So, and we have added some innovations too. So, we are offering well diversified portfolio of 20 stocks for investment amounts as low as 25,000. So, say in mid caps, so which is really difficult to do, but since like we use optimization techniques, it's like a constraint for us which we'll have to pass. And recently we went live with factor investing and sector tracking portfolios too. And we believe, we are here to add value for the active management fee, and we are. It's an algorithm which is kind of proprietary. So a lot of people do factor based investing, but we don't do that. So we have our own approach, uh, uh, and the performance of my core portfolios matters, and that is where I'm seeing a good outperformance. Apart from this, we want to
offer trading advice to. So that is what we are currently working on to build a tech platform.
Got it. Got it. That's really cool. I mean, obviously, the proof is in the pudding, right? So if you guys are outperforming the indices, then it doesn't get better than that, right? Obviously, these things take time, but that's really cool. So obviously, we will include all the relevant information on Quantace in the show notes. As the last question, Karthik, this is what I ask, all my guests. What are your goals for yourself and for Quantace over the next 5-10 years?
I mean, for myself, I would say that I would like to work on other problems out there. So, uh, I mean, it's kind of a research which takes a lot of efforts. So, I love to continue working in my research role. But as far as Contest is concerned, we would actually wish to expand into, say, international indices and offer portfolios for indices such as SPX, say Dow Jones, Hong Kong Index, and we hope to start our own PMS one day. So, if regulations actually permit, we plan on offering crypto portfolios too, and and we wish to actually create a tech platform where we can offer customized solutions to our clients, and we want to manage the journey end to end, from right from, say, onboarding to investing. So, and we also plan to open up our APIs to other third parties, so that they can build some fantastic applications for the clients. So if everything goes well, this is what my I mean idea is, because I have very optimized algorithm which can produce a result in, say, milliseconds. So I want to open my algorithm as a service for other people to use it.
Got it. No, it's just really cool. And like what I appreciate about that is you guys are in the algorithmic space, in the quantitative space. So obviously that also frees up your time, right? Because you're not spending a lot of time making discretionary decisions every day. You're letting the algorithms work for you. And you have now the time to think about these other problems, which is really cool. So, amazing, so, all the best, to you guys. And, we will include all the relevant information on Quantace in the show notes. Thank you so much, Karthik.
Yeah, thanks, Raghu. It was nice talking to you.
Likewise.